Ryan, we've turned to you oftentimes on air and on social media for some of those big kind of statistical measures that you look at. What exactly stands out to you for 2023, just 3 weeks into it?
Yeah, Dom, thanks for having me. And again, good morning. I mean, you kind of laid it out there, right? I mean, just how strong the start to this year has been. And, so goes January, goes the year. It does have a good track record. Now, you just mentioned some of the numbers, but here's another one. I just found this over the weekend. When the year before is down, okay, and January's up 5%. So we're not there yet, but you're telling me there's a chance. Only happened 5 times, Dom. That full year has never been lower, up close to 30% on average. Last time was in 2018, 2019. So again, that's just one way to look at it. But when I look at the market, right, and I see some of these risk on things like high beta drastically outperforming low beta, that's a 180 from what we were seeing this time exactly 12 months ago. So we can get into more things, but we're seeing the right leadership. And we're on record at Carson Group saying October was the lows. That was the lows of the bear market. We've said that many times. And we think likely this year is going to be a lot better than most people think for stock investors.
So okay, we've got a lot of moving parts, a lot of variables, Ryan. I mean, the Fed and interest rates, you could argue, the biggest driving force behind the market declines last year, along with some geopolitical risks as well. Is it as simple to say that this year is just about buying the stuff that was beaten up last year and selling off the stuff that was good last year, or is it more nuanced than that?
Yeah, we think it's a little more nuanced than that. I mean, you mentioned the NASDAQ, right? It's having a huge month. We don't think technology and communications are going to be these huge winners this year. We're more even weight that. We think cyclicals. I mean, our base case is we don't think there's a recession. And I know not many people are saying that, but we still see a strong consumer. Look what American Express said. Look what Visa said. The consumer is still strong. Things aren't perfect, yes, but we think we can avoid a recession. And we're sticking with some of those cyclical value names, your industrials, your financials. Look at materials. Materials have just started to turn higher. Your copper, your nickel, your zinc, China's reopening. I mean, so, there's going to be opportunity across the board. But I think the key concept, again, being, I guess, let's put it this way. Last year, yes, your utilities and staples did better relative. We don't think they're going to be the big leaders this year. We think it's more those cyclical names. And technology, again, more even weight. But it's nice to see that leadership coming from tech finally, because as we all know, what's it make up? 25, 26% of the S&P. That's it's important for this bull market to continue. We are thinking it's a new bull market, honestly.
Ryan, you and I were both around in the wake of the great financial crisis, and it's fair to say that we've been in this kind of U.S.-centric and then now global zero interest rate policy for such a long time. You could argue there's a generation plus of investors who've never seen a rising interest rate environment, and inflation's only exacerbated that. How can you use history as a guide if we are in what some call such an unprecedented market?
Yeah, did you just say we're old, Dom? By saying
I did, Ryan.
Yeah, nice way of saying that at 5 a.m.
Right.
No, you're right. I mean, one of the 4 most dangerous words, Sir John Templeton. This time is different. I mean, so we really are seeing, coming off of COVID and then the supply chain issues and all these things. So yes, there are some differences, but I'll tell you, at the end of the day, let's take a look at the U.S. dollar, right? What have we seen historically? When the U.S. dollar is strong, Dom, we've seen this several years now. Things don't do as well because it hurts global earnings. And again, we talked about the Fed a little bit. We think the Fed's got maybe one more rate hike, take their foot off the pedal. Other parts of the world are going to start hiking more. The dollar price is going to have a downward pressure. What history tells us, we can all agree on, I think, at least last 20 years, a lower trending dollar is more of a tailwind for risk assets. We think that's the case we're going to have. And we're in the middle of earnings season, right? Earnings have not been that great so far. I mean, let's be honest. I know more big names are coming. But if the dollar continues to be weak, that can be a tailwind. A lot of people aren't thinking. The reason earnings aren't so great is because we're dealing with that huge spike we saw last year in the dollar. We think the dollar lower is kind of one of the big keys to the whole thing. The Fed, of course, is important, but if the dollar continues to trend lower, at least stops going higher, that's a major tailwind we don't think people are giving credit for.